Most of us think hyperinflation is just for history books and failing states. But Americans are making a dangerous mistake by ignoring the debt-to-GDP reality that historically precedes a currency collapse. Hello, and welcome to the 81st edition of Crossing Thin Ice, a podcast series about risk management for insurers. I'm Dave Ingram, and today, as always, I'm joined by Max Rudolph. Today's topic is hyperinflation. Max is going to be answering a lot of important questions about hyperinflation, such as, could hyperinflation realistically happen in the United States? In what ways is the U.S. dollar's global dominance currently being challenged by foreign nations who are seeking alternatives like gold or the Chinese yuan? How do the assumptions of modern monetary theory, or MMT, compare to historical financial disasters? How can risk managers leverage artificial intelligence for sentiment analysis and stress testing? And what are AI's critical blind spots when it comes to predicting black swan events? Before we start, I do want to mention that nothing in today's podcast should be interpreted as investment advice, but it is sure to be educational and thought-provoking. Let's get started.
Modelers in the U.S. have long ignored changes in the rate of inflation, assuming something in the 2% range that aligns with Federal Reserve Bank goals and then assume it does not vary from there. Those in post-World War I Weimar Germany, Zimbabwe in the decade following 2000, and others have experienced levels of inflation that show us hyperinflation is not just theoretical. Features often include a collapse of production and debt denominated in foreign currencies. The government becomes illegitimate and can't collect taxes. Could it happen in the United States? Should risk managers develop a game plan? At its core, inflation is based on trust, plays out through actions, mainly by printing money under a fiscal dominance scenario, where the central bank is the primary buyer of government debt. There are two extremes. If I don't trust the economy and think prices will fall, I hoard currency and defer purchases, and the turnover or velocity of money is low. This leads to a stagnant economy and is deflationary, or at least disinflationary. If I don't trust the system and expect prices to rise, then I prefer purchases of stuff to holding currency. The United States is cushioned in hyperinflation scenarios by its reserve currency status. The dollar backs much of the global economy, and many currencies are pegged to it. However, this is a privilege. Punishment to the Russians following their Ukraine invasion included making it harder for them to participate in trades involving the dollar. Now countries know that the U.S. treats the reserve currency as a political asset, so some are letting their U.S. treasuries mature without rolling them over and buying gold instead. Some trading blocs use the Chinese yuan, but this volume is relatively small for now. In my lifetime, the only burst of inflation in the U.S. was due to the oil supply shock of the 1970s, where inflation spiked to levels near 14%. As we prepare to celebrate 250 years of independence, only Revolutionary War money printing in 1778, where we get the term "it's not worth a continental," and briefly during the post-World War I influenza depression of 1920, saw inflation reach 20%. It doesn't happen often, and recency bias encourages us to think it won't happen in the future. In 2022, inflation peaked at just over 9% due to Keynesian stimulus delivered directly to consumers and businesses, but it did not persist at that level once the direct payments stopped. Deficits have been consistent and growing since the small surpluses run during the Clinton era, and the debt-to-GDP ratio continues to rise, now above 100% even when ignoring off-balance sheet commitments, and above 120% when they are included. The Federal Open Market Committee set its inflation target in 2012 and allowed additional flexibility in 2020 during the COVID crisis. It has been above its goal recently, but still is nowhere near the 50% monthly rate necessary to be officially considered hyperinflation. Fiscal budgets for countries often grow to high levels during a war or financial crisis and it is recognized that these deficits need to be reversed in the years following. People understand that, and while not happy to have to tighten their collective belts, they begrudgingly do so. Voters hold politicians accountable, and central banks tighten monetary policy. This contracts the economy, but can be offset by soldiers returning home eager to work, spend, and start a family. Modern monetary theory, or MMT, assumes that a country with the reserve currency can run deficits without risk of inflation. But this assumes revenues eventually balance spending. The high levels of debt in the US, combined with the challenges being made to the dollar, mean that the United States and other developed countries are not nearly as resilient as they had been, and the risk of hyperinflation should not be ignored. Let's consider some historical events and their causes. The most studied period of hyperinflation is 1920s Weimar Germany, forced to print money and run deficits to pay for overbearing World War I reparations. Workers were paid in cash and immediately visited markets before the currency's value became misaligned with prices. Economic conditions interact with political outcomes. This period laid the groundwork for a global depression, the rise of the Nazis, and World War II. Greece experienced hyperinflation near the end of World War II, and Hungary experienced a period where prices doubled every 15 hours immediately following the same conflict. Events in individual countries can also lead to hyperinflation, with examples occurring in 1920s Russia, where it lasted 7 years, the longest continuous period in history, and followed the Bolshevik Revolution. The 1990s Russia, where you had a breakup of the Soviet Union with price controls lifted. Yugoslavia in 1992 due to war. Zaire in the early 1990s due to runaway deficits. Zimbabwe in 2008, another printing press event, and Venezuela in 2017 due to poor economic policies. Currency stabilization can incorporate conservative fiscal and monetary reforms that restore trust in the currency. The new currency was backed by land in Weimar Germany, but typically a combination of gold and foreign currencies is used. Central banks are created or become independent. Fiscal austerity is introduced to eliminate deficits. Regulations are tightened, and the currency is devalued or tied either directly or indirectly to a foreign currency. Policies that have been tried unsuccessfully include confiscating bank accounts and price controls. These lose trust with their citizens while also slowing the economy, encourage under-the-table black markets, and result in shortages. Successful policies are implemented quickly, and there's often a change in leadership at the same time to make the changes more credible. Inflationary expectations drive results as if they are self-fulfilling. If high inflation is anticipated, workers will demand offsetting wage increases. Prices and wages participate in a cycle where each drives the other higher. A previously ineffective monetary policy must earn back the trust of the population to be effective, although a recession can also dampen prices. Multi-year negotiated contracts can also make it hard to tame inflation. Payments and wages may include a cost of living adjustment or COLA. These automatic adjustments make it hard to fully eradicate inflation. Sometimes you will see shrinkflation in products where sizes get smaller or non-wage benefits added rather than salary. During World War II, this is how group health insurance was first offered. Wage increases were capped, so alternative benefits were developed and offered to employees in order to retain them. Risk managers should develop scenarios that consider double-digit inflation quantitatively and both stagflation and hyperinflation at least qualitatively. For many firms, these extreme scenarios result in bankruptcy as hedges are ineffective when tight monetary policy takes effect. While lagging indicators like the velocity of money are useful, risk managers should be proactive by scanning for leading indicators of high inflation, like the M2 money supply metric or the price of gold and other commodities, watching the supply chain and thinking about extreme events. Narrative scenarios should be explicitly developed based on what the metrics say. One example might be based on the dot plot Fed funds rate projection generated by the Federal Open Market Committee. with scenarios built around changes in interest rates, GDP growth, and liquidity. There are no guarantees, but those who plan ahead are often better placed to navigate changing environments.
So, Max, that was good stuff. Help me out here. You mentioned early on in what you just said something about central banks buying up the government debt. Can you explain what repercussions are of that and how that differs from just selling the debt to non-government entities?
Well, this is one of those topics that I'm still learning about all the time. I mean, it's essentially what the U.S. government is calling quantitative easing. And so, in a fiscal dominant scenario, the government prints money, but all the debt that is created by that is bought by the central bank rather than going out to individuals or foreigners or anybody else. So it kind of creates this closed loop that if you let it go on too long, has bad results. So you have to figure out ways to unwind it at some point. It's something that the US had not done before 2008. And so in my mind, it's still kind of a lesson in experimental economics. Do you have thoughts on that, Dave?
In that way, you're expanding the money supply there, whereas if the government spent the money and borrowed the money from within the economy, they wouldn't be expanding the money supply by doing that extra spending. They're just reshuffling where the money is in the economy. So I think that's the big difference there, and I think that makes a huge difference in this discussion of inflation. All right. Well, Max, I got another question for you. What do you think? How does the shadow banking system impact inflation?
Thanks, Dave. Shadow banks include any group that's not regulated as a bank that generates credit by offering loans or derivatives. They include hedge funds, insurers, pension funds, and other financial firms. Without the reserve requirements of banks, these firms act as inflation multipliers in both directions, really, keeping the party going when times are good. This can create pressure on the government to continue loose monetary and fiscal policies. If they lose control, this results in high levels of inflation. I have trouble imagining how this happens in the US, really without an autocratic dictator, since an independent Fed and Congress provide oversight and perceived accountability. There's also a chance for recession or deflation if the government slows bank credit creation and shadow banks leave the party. This happened in 1929 and 2008 in the US and was very painful financially. Having adults in the room to provide oversight may seem a burden in the short run, but often keeps risks from growing before they blow up.
Thanks, Max. Next question. What do you think about modern monetary theory? Do you think it's consistent with the problems that happened in France and the devaluation that resulted from the Mississippi Company and John Law way back in the 1720s?
Yeah, this is a fascinating topic. Hyperinflation impacts the nominal cost of all goods. John Law pegged the currency to shares of the Mississippi Company rather than gold, although there are similarities in what he did to Keynesian economics that we use today. In both examples, the public loses confidence in the currency and tries to rid themselves of it as soon as it comes into their possession. And in both situations, an economy ends up with a worthless currency. So you don't ever want to be really compared to the Mississippi Company, just like you don't want to be compared to tulip mania or any of the other bubbles of the past.
Sure, that's a good advice there. Help us out now, looking more broadly. Yeah, those are things to avoid, but what things do we want to gravitate towards? What assets have performed the best in the past for hyperinflation situations?
Yeah, this is definitely something you want to think about in advance if there's going to be a hyperinflation scenario. In the recent past, we've seen fertilizers have been kept from supply chains during both the Ukraine and Iran conflicts, but prices adjusted very quickly. You needed to be ahead of that. In general, it seems that liquidity and portability are more important in the short run, and defensibility matters most over the longer time horizon. There's a reason they call it the gold standard. Although, like a bearer bond, possession is all that matters to those fighting for survival. Gold is also the natural black market exchange with small coins used for daily transactions. Farmland produces food, so it's a natural and universal currency. It can't be moved and can be taxed or seized, but they often produce crops that are indirect food sources used to feed pigs or cows, so not directly for human consumption. The rule of law can't be repealed if this is your plan. How do you protect an edible crop from a mob of city dwellers who are hungry? I don't think you can. Foreign assets are good if you can access them, especially as things settle down, if you can bring their current value back into the country. Local equities are likely to do relatively better than currencies since there are real assets like machines and buildings backing them. And in general, stuff, whether it be commodities or tools or buildings, will relatively perform well if they do not depreciate in the meantime. So some have borrowed in the declining currency to buy the tools of production. Don't buy assets that depreciate rapidly, like clothes or something silly like decorative plants. Dave, I've got a question for you. How can artificial intelligence help in developing the narrative scenarios I discussed earlier?
Well, if you're a risk manager, I think AI can be a big help, but there are some limitations to that. One of the things that I've not done, but I've heard about is the way that AI can do what it calls sentiment analysis. And what that means is it's looking at lots and lot of sentences that people have put into the social media mostly, but also into news commentary and other electronic forms. And the AI, since it is a language model primarily, is pretty good at analyzing language. So it can look at all this language and it can give you a judgment as to what people are saying and what kind of feelings that they're expressing about the economy, about the currency, about prices, whatever. And so that you can set up a monitoring system where you can look at the comments that are being made on the X, the old Twitter platform, for instance, judge the sentiment there. AI can also help you with analyzing large data sets. There's lots and lots of financial data that's available, and it takes a long time for a human to analyze all that. But if you set up the analysis, you can get really quick feedback whenever new data sets are released by the Federal Reserve, by other government entities that are tracking data. You can also use the AI to help you with stress testing so that as you imagine new wrinkles to scenarios, you can look and see how does that affect the company. I'm finding from my own work requires some fairly careful building of the setup to do that. AI doesn't necessarily know how to look forward. Insurance companies are fairly complicated, so you do need to give it some instructions on how to project forward an insurance company to get that. Some of this information about the shadow banking that you mentioned, Max, there is information out there about it. It's pretty sparse, but it's there, and AI can be collecting that for you. I mentioned limitations to this, and they're pretty severe, the limitations, which is that AI is particularly poor at seeing an inflection points. So you're going to have to judge the inflection point. Yeah, when you see the sentiment going, you're going to have to be the judge of when you think that the sentiment has really shifted drastically. AI can look at historical data, but it just has no intuition. to be able to do things like that. And that's particularly important when you're thinking of black swan types of events, and hyperinflation certainly is one of those black swan events. And also, you don't want to ask the AI, what'll I do in this situation? Because it won't be able to figure that out very well either. The advice it'll give you will be pretty useless in a situation when you start doing to see that. The other thing you need to do is pay attention to whether or not the AI will have blind spots, just as a human analyst might. I don't know exactly what those are, but I'm just telling you to be careful with those and pay attention. Allow for that possibility. The AI is not all seeing and all knowing.
Yeah, it seems to be a consistent message about AI that it can be a great tool and can improve your analysis, but you want to provide some oversight on what it's telling you, either confirming it or giving it some thought yourself as an expert and with experience that can apply foresight to their recommendations. So, but that's interesting. Thanks for adding that to the discussion.
Thanks for listening. Before I let you go, I wanted to share my takeaways about this topic. First, hyperinflation is a real risk driven by fiscal dominance and a loss of public trust. It occurs when a government prints money and the central bank becomes the primary buyer of that debt, causing the public to lose trust in the currency. Second, modern elements like shadow banking and artificial intelligence complicate both the acceleration and the monitoring of inflation. Unregulated shadow banks, such as hedge funds and pension funds, act as dangerous inflation multipliers, aggressively expanding credit when the economy is good, but threatening severe contraction if they pull back. And risk managers can use artificial intelligence to track those complex risks and run public sentiment analysis. However, human intuition remains necessary because AI struggles to identify sudden economic inflection points or predict black swan events like hyperinflation. And last, public expectation of inflation can create a self-fulfilling cycle through wage price spirals and shrinkflation. When people anticipate ongoing high inflation, workers demand higher pay to compensate, creating a continuous loop where wages and prices drive each other progressively higher, and businesses adapt by shrinking product sizes as a creative workaround. You can share your takeaways in the comments if you like. We hope that you have enjoyed this edition of Crossing Thin Ice, and if you did, please like, subscribe, and share with your friends. Thanks. Bye.